Okay, session is being recorded. This is an advanced coaching session for tonight. I am making this free, so it's going to be uploaded on the YouTube channel for public access. Doing this as a favor to all the members and free trial subscribers who shouldn't be excluded given the critical circumstance in the market that they should be prepared for going into this week and going into Monday, tomorrow morning. This is Clueless A Trading Frank. This is purely for full disclosure. This is purely for financial education and not for any solicitation or advice. Just want to make sure that everyone is looking at the can see the screen and hear the audio. As far as we know, everyone is. Anyone walking in, please identify yourself so we know who's attending this particular session. Okay, let me kick off. And this is extremely critical, and I mentioned this in my previous video cast too. What we are going through right now is unprecedented. There is no way of exactly telling what the next move on the market is going to be. What we attempt to do as tactical players in the market, and I've gone through quite a few of these type of crashes in my trading lifetime over the past many years, is that there are certain patterns that the market follows. And there's an old saying that some of you know, I've said it before, that every crisis is exactly the same for different reasons. And that is exactly what's going on. This is obviously a crisis of monumental proportions, purely because of the fact that that one of the first world nations, the United Kingdom, has made a huge political statement via a referendum which passed by what I consider to be a very narrow margin, 51 to 49% or 51 to 48%, with 32% of the voters sitting on their butts and not voting. In my opinion, I believe that if that 30% did vote, we would not have had a Brexit situation as we encountered on Friday. Let me just be very clear about one thing. We as tactical stock traders, market traders, we are not here to make political statements. We're not here to basically espouse a particular political theory. We are just looking at the economic ramifications and consequences of a monumental vote by the population, by the people of England, and whether they are totally right or wrong is actually not for us to determine. What we have to look at is how much, if it's hurting our pockets. When it starts to hurt our pockets, we start to get pissed off. And we don't care if they're English, Italian, French, Moroccan, Egyptian, Indian, Arab, Middle Eastern, some Dubai billionaire, or whoever they might be. What we're looking at is how it's going to affect the U.S. financial markets and how it's going to affect our livelihood in what we do, which at least I do on a full-time basis. Because when you're writing your own paychecks, as we do as independent traders, we don't want other people to keep on messing with us, period. So, saying all that, I think it was a really dumb move. Now, there's a lot of theories on that, but on a short-term basis, they could have done this differently. But when emotions take over, just the way it does in stock trading, you do stupid things. And that's exactly what happened. Whether or not the EU is a major bureaucracy, which I believe it is, whether England ever benefited from being part of the EU, I don't think they really benefited, to be honest with you. This is not the way to go around it, because what they did was they shot themselves through both knees. The Irish Republican Army fought England for Irish independence for what, 30 years? And they used to do something to punish the loyalists, which were the Irishmen who basically supported England. Okay, the IRA were basically the anti-British movement. So they used to put 2 bullets to the knees of the politicians in Ireland to teach them a lesson. It's called kneecapping. So they didn't kill them, but they disabled them for life. Well, what the Brits short term did is, without thinking through the whole situation, they basically kneecapped themselves. So they think that they're going to benefit from this move. Well, it ain't happening. Okay, it ain't happening. And now a lot of them are starting to regret it, because when you start too much of your thought process through your head and your heart, whether it's in trading or in a political atmosphere in a nation, trust me, it doesn't do anything, because rational thought doesn't come in. It's emotional thought, which is fine. So we're not here to debate the rights and wrongs of it. We're simply saying what they did was, the way they did it was plain old stupid. Global markets lost $2.5 to $2.6 trillion in one single day alone. If somebody comes and tells me that's really a good thing and they did the right thing, well, obviously they're not they're not true capitalists, to be honest with you, and they don't know what the heck they're doing by being investing or trading in the market. Traders, okay, have to think twice about how this will affect both the long side and the short side. So saying all that, my job is not to find a political solution to this matter. My job is to basically simply look to see how we can maximize both on the long and short side from this situation that occurred. And that's really what it is. So we're going to attempt to do that. Before I go any further into these charts, you have to understand one thing. Charts will only show you a roadmap, but the roadmap is filled with mines, okay? So as you're stepping forward into trying to trade these markets going into Monday, and this has happened every single time the markets crash, by the way, real crashes. This is a real crash, monumental. This was actually the biggest single day crash, more than the largest one that happened, I believe, in September of 2008 during the financial crisis, in one single day. I'd like to remind everyone that net, despite the drawdowns on particular long positions, we actually made some decent money on a tactical basis, both on the short hedges for the ones who did buy a few of the short hedges, and I had few. But that takes away some of the pain from the long side on some of the ones that we were holding as swing plays, for example. But even in intraday, we had some real powerful runners, 40 to 50% on a runner like BSPM from nowhere. But I alerted it. And then the swing trades on Sarepta and other and then what do you call the tactical plays that we did using the S&P 500 options during the day. That's what my service offers. Now what you do with it and how you react to those trade alerts and how quick you are on your foot, on your hands to do the buy and selling, that's your business, not mine. Because I'm not running your book. So you guys better be very, very, clear about that. My job is to not run your books. My job is to be very tactical, show all through the day I did. Charts, reversal candles, points where the markets would basically get to, fail, all kinds of stuff. And then you have to do what you need to do. You can't do it. If you think that you can't do it, then don't trade. Don't trade during that day. Take a week off. In my opinion, we'll probably make the most money this week than you'll make in a long time. But in order to do that, you have to be extremely focused. You cannot take your eyes off the screen. So if you think you're just going to waltz in by buying something at 9:30 or 10 o'clock, and you want to come back at 1 p.m. and you want to come back at 1 p.m. and like, oh, I'm making a lot of money. Well, kiss your book money goodbye. You have to be, this is total urban, hand-to-hand urban warfare. Okay? And I'm going to walk people through what I have seen before, might happen, but, and then you listen to all this tonight, and then you walk into the battle zone tomorrow morning. I don't disappear. I'm always there. No service has this type of hand-holding, to be honest with you, even though I hate that word. Hand-holding and direct, what should I say, suggestions and alerts in real time, and at the same time answering a significant amount of questions. No service offers that. So if any of you have any complaints about service issues and stuff, well, I'll be honest with you, like they say as a New York trader, you can just zip it. Because the amount of effort that is going in to walk people through these extremely powerful dynamic minefields that we call the stock market, especially at times like this, by the end of the day, I am exhausted. Mentally, I'm sapped. I wouldn't be if I didn't have to run the service, to be honest with you. And I'm not even making any real money off this service because of the low rates that I keep, to be honest with you. It's almost laughable. So for the amount of value that you all are getting, and I'm saying this with a smile, okay? This is not a complaint. I'm just reminding people. The amount of value, added service, VAS that you're getting for a very small amount of fee every single month, okay, is enormous. And if you still can't handle it and try to make, really try to get the best out of it, then you really have to think twice whether you want to do this business or not. And remember, I'm no like some sort of God-given genius with a crystal ball knowing exactly where the markets are going to go every 10 minutes. You have to use me. You have to look at other stuff that you look at. Maybe you have another service you're following. Maybe you're looking at somebody else who's looking at a different viewpoint. And then you mix it all together. I am just simply one resource among many that's available out there. But my level of thinking and prediction and as such is basically different. And at the same time, I believe very, very accurate. I'd like to remind people as we move along this path into tonight's session that I went ahead and told people specifically to take down any large profits, take down positions if necessary ahead of Brexit. They squeezed the market to the point that they just shot the market to exactly where I said the market would go. I don't need to ask you guys if I'm correct or not, because I am correct, because look at it. The exact levels that I pinpointed where the market was going to go, it went exactly there to the teeth. I mean, this is scary. So once it got there, why the heck are you going to leave large unexposed positions out in the market? Because one way or the other, if Brexit or no Brexit, the market would have pulled back. If, let's say, for example, the Brexit thing didn't happen and they remain. What would have happened is market would have gone up 100 points and immediately sold off. Because technically speaking, you are extreme overbought at that point where you need to, you're right there. I mean, I've other charts which I showed you guys clearly with the ones with big captions saying direct hit, exactly as forecasted. So let me also remind another one, because part of my service is being a mentor, and a mentor is not supposed to be all sweet and kind. A great coach, and I'm not a great coach, I'm a coach, okay? Doesn't look over your faults and say, oh, it's okay, you're doing it right. No. A coach tells you that you are a complete screw up because you're doing something wrong that was told not to do. And one of the things that I find that a lot of members are not doing, not a lot, maybe some, is they are not looking at the charts. And the charts are so clearly marked, it's not even funny. And some of them are saying, I don't understand the charts. I mean, I'm not blaming them for not understanding the complexities of some of the charts, but looking at simple stochastics, overbought, oversold, with markers. I put big fat markers in there, right? Writing down, kindergarten style. Arrows, lines, where certain levels would go. How could you not understand that? If you don't understand that, you need to go back to maybe 5th grade. I'm being serious here. There is something fundamentally wrong with somebody's brain when they come and tell me that they don't understand a chart which is marked that even a 5-year-old can understand. I'm being dead serious. I'm not insulting anyone. Yes, you might not understand the moving parts of that chart during the daytime. That I agree with, because there's a lot of indicators moving back and forth and not giving you straight answers. Okay, I take it. I understand that. That is tough to understand that part. That will come out of practice. That'll come out of practice. Any new profession that you're trying to do, you will need to basically keep on doing it. And it might take 2 years, 3 years, 4 years. It took me a long time to really figure out what the market's all about. And even then, the market doesn't do exactly what we think it's going to do, because the market is a game of probabilities. It's not a game of certainties. But when it comes to basic chart reading, the level of charts that I put out there are not difficult to understand. So look at yourself in the mirror and ask yourself, what is wrong with you, not with my charts? Because there is nothing wrong with my charts. And I just want to make this very clear, because I don't know what else I need to do. So I just want to be very clear about this, okay? So take it seriously, look at yourself in the mirror, and you say, okay, yes, I do agree that you might not understand some of the patterns which are in play. Understood. Well, I have spent enough free time, enough free sessions where I've walked people at my own time, different patterns. I have given web links of fantastic sites which explain all these different patterns. So it is your responsibility, and I'm talking to the new members here and the old members too, who still don't understand patterns. Your responsibility is to sit there for a few hours, literally, and go keep on looking at the patterns and understanding them. So when you see them in real time in the markets, as I draw them, then you understand it. So let's not act childish here, okay? Let's be grown adults. You don't understand the patterns, well, put in the hard work for it. And then as I apply those patterns on the actual charts of the market and try to make sense out of it, then it'll come to you. If somebody doesn't understand what a gap fill is, they shouldn't be on my service. I'll be honest, get out. Because all you have to do is go to Investopedia, like I've said 100 different times, which is the encyclopedia dictionary of anything to do with investing, and type in, or in Google, just type in gap fill. What's this, technical analysis term. Copy this URL right now. Copy this URL right now. And keep it forever. Everything you need to know, every single term is right here. When I draw something called an ascending triangle on top of a thing, and I've been right on the ascending triangles, okay? A flat top and like this, and then the market keeps on doing this, and then boom, breaks out. Well, here is your ascending triangle. So bookmark this right now. So next time you don't understand a technical term, Don't expect me to write a long-winded explanation of that in chat. I'm doing stuff like my hands are falling off during the daytime. Okay? So it's time to take personal responsibility. And if you don't take personal responsibility in your own learning, in any industry, not just in trading, don't expect somebody else to spoon feed you. Because by the time you're being spoon fed, you're going to gag on the spoon. Seriously. If you think I'm being hard and direct, well, that's me. I'm being direct. And you're going to thank me for this. A few days from now, a few months from now, hopefully not in a few years from now. In that case, you're really slow. A few weeks from now, a few days from now, you'll say, Clueless Trading was dead right. I need to take personal responsibility. So this particular URL, copy. I'm even putting it right there in the website public chat room. Can't get any better than that, okay? Putting it right here on the GoToMeeting chat. Anything you need to know. What's a bearish engulfing pattern? A blow off top. This one's a blow off top. A lot of them I don't even understand. I don't need to understand. Bullish abandoned baby. I'll leave that one alone. Okay. Bullish engulfing. Very important pattern. All you do is you click it. I've shown this a zillion times. In smaller body, that's an inside day, that's a bullish engulfing, which takes over the previous day's candle, makes it and surpasses it. What's so difficult to understand? All you have to do is read. Am I clear on this? And I need a response from everyone.
Yes.
Marcos?
Yes.
Good. You know exactly what I'm talking about, my friend, okay? Need to put in the hard work. Paras, you understand what I said, right?
Yes.
Agzita?
Yes.
Okay. For EMA, can you hear us?
Yep. Yes.
Excellent. Excellent. And who is the other person here? It says waiting for name. Charles Bailey. Okay. Good. So let's move on now. So this is an extremely important site. So you know exactly what these terms are. You don't need to memorize every single one of the terms. But as I'm putting these, I use certain of these terms quite a bit, technical, because those are the technical patterns that I see. This Chandy momentum oscillator, I have no frigging clue what that is. Buy signal. Chiku span, no idea. I don't know what it is. You don't need to memorize all of them. Just keep on going. There's tons of them. All right. So let's get back into this here. So let me just start talking about the markets here. Now we're clear off with everything. Every single chart that I post during the daytime has some relevance to your profit and loss in your portfolio. Whether they're directly correlated with a particular stock that we're trading, or if it's tied in with the markets. So make sure that you take a look at them, because one way or the other, they're going to help you lose less money and make more money. Very, very important to look at the internals too. And the simplest way of looking at the internals is to look at the stochastics. I've said this 100 and 1,000 times probably, and say it again. Internals overbought simply when they're below 20, with extreme overbought, similar to the relative strength index. Don't understand what that is? Please go back here and look up relative strength index under R. Go to the next page and third page, wherever it is. Because these are the basics you have to know. So the stochastics are the best ways to look at it. But in markets which are run on emotional depth and pure panic, or too much excitement, like was the case on Thursday before I went to my son's graduation, both excitement, overconfidence, and panic which is basically extreme fear, are both detrimental negative factors in a trader's trading book. Both of them will kill you. Overconfidence, which means complacency. Sit back and you think, oh, it's just going to keep on going higher. And pure panic, as is the case right now. Both will destroy you. I've said before, and I'll say it again. Confidence is not something that's just automatically written over everyone's face in their minds. It is something that you work very hard to earn. It is something that you thank yourself because you did something strong, powerful, and disciplined. Many times I'll put out trades out there, and you guys can all attest to it, where you guys don't understand why I did it. It's fine, because if you knew that I knew everything, that it's going to go there, then what's there to understand? That's overconfidence. That's dangerous. The biggest trades and the largest trades in the world made by the most phenomenal and legendary traders and investors, they have said they don't sleep at night on those trades. During the housing crisis, John Paulson, one of the hedge fund managers, he made something like $13 billion shorting the housing market. He said he couldn't sleep every night. Why? Because he thinks the market was going to crash the next day? No, because his fear was, and it's happened, that the Federal Reserve would suddenly come in and cut rates and the markets would be up 500 points against him. And it happened. He couldn't sleep. And the larger your trades are, the less you will sleep. And the more nervous you will be during the daytime. That's why the other day I asked people, are you scared? And I meant it. I was scared and cautious, but very positive, confident about my trades. So somebody can say, how can that be? Well, of course. Your adrenaline has to be on constant defense with an offensive mentality, with a mentality of offense. In other words, you know you're going to win on that trade, but you're nervous because you put in money and you're ready to buy more if it pulls back, as long as the technicals are holding. So these are nervous times. But that doesn't mean you have to be an idiot and do the stupid thing like sell just because the market pulls back a little bit. I'm not talking about Brexit. I'm talking in general, which most traders tend to do. And most traders tend to be very excited when a price is running and they're not watching the internals, whether they're getting overbought or overbought. When prices get overbought like this, and just such simple things, I mean, I can't even tell you how simple they are. Prices get overbought like this, and the stochastics are overbought too. You know, and I know, because I put it out there too every single time, that you are going to get a pullback. You get pullbacks. Right then, most traders start to panic. Here, they're a little bit too happy because they bought my alerts. They don't take profits. I know people who have done that repeatedly. Oh no, this is really going to No. On a daily chart, when you see overbought conditions, you better be careful. You get overbought, you get a pullback. You got a pullback. Again, it gets into this deep oversold region. This was a double bounce. Big buying opportunity. Big buying. So not that hard to understand. So don't get overconfident. Don't panic. Don't extreme panic. And don't think the market will just turn around and run up. These are dangerous times. It is a time of maximum opportunity, in my opinion. As long as you play with small sizes and you're flexible to change your direction on a moment's notice. Okay? We are tactical traders. All I'm trying to do in a very precise fashion is trying to read the signals as quickly as possible, or maybe a little bit prior to the moves happening. So if that's the case, I can change my mind in 15 minutes, if not 15 seconds, but in 15 minutes, I can be a bear or a bull because I'm reading the signals on the market. Now, if you cannot bring yourself to adapting that type of mentality, then the markets will finish you off and you will be buried. We don't know if the bull market has been broken just because the Dow dropped 700 points. We'll look at some of the signals tonight and we'll see. No one can tell you that they're going in the bear market. You know, at the time that people can tell you when they're going in the bear market, they can tell you that 3 months after they look back. Oh yeah, we're in a bear market. By that time, the bear market's over. But there are certain simple things that I look at, which I've explained many times, which are the moving averages on the 50 and the 34 primarily, these lines, whether they are starting to crack down and remain down like they did here. And it lasted a few months, from December all the way through February overall. And the lines kept on crossing down, and every time the market, you know, these were extended periods of oversold conditions, as you can see here on the stochastics. It just never could manage to go up. And this was a few months. People freak out over a few minutes in the market. They think the world has changed in a few minutes. Imagine few months. So we don't know if we're entering that stage yet. And I will do my best to identify that and in general, keep a short bias if the trend change has happened, okay? But that'll only happen if I start to see the moving averages start to crack down and cross over down and remain in a trajectory which is lower. Is everyone clear on that? Is everyone clear on that?
Yes.
Yes, yes.
Good. That's the only way to tell if this market is going in a protracted bear market. There are many arguments that can be made that a significant amount of money that's invested in the UK will have no home to go because they did what they did, kneecap themselves, playing with a loaded gun. That money finds a home. Where is it going to go? To China? No. To India? Yeah, partly. India is still an emerging market. They'll come to the United States of America and our companies, which are the finest in the world. And that's a fact. They're well run. They're transparent. We have the deepest liquidity in our markets. In other words, there's always a buyer or seller involved in the markets on a daily basis. And we don't have, despite robotic manipulation by algorithmic high-frequency trading programs, we don't have complete manipulation like they have in many different markets. The Chinese market is completely manipulated. That's one of the reasons why they were not added to the MSCI World Index. Some of you know exactly what I'm talking about. It's a very prestigious thing when you're added to the MSCI World Index, because then fund managers can buy that index and your country's large number of the country's main stocks are in there. China was not allowed to do so because their markets in general need to grow up and behave like an adult and not like a drunken teenager, because that's what happens in their markets. It's a fact. So with the Brexit crap that happened, money will come to the United States of America. There's a huge opportunity, and the selected stocks and stuff that we play, and as you know, I don't play crappy stocks. I play name brand stocks, which are world-class companies. We have a shot to benefit from this crisis. Remember that old saying, right? It's a Chinese saying. In every crisis, there's opportunity. Believe me, in every crisis, there's an opportunity. It's for you to find it. It's for me to actually find it, and for you to do what you need to do. to make the best out of it. So let's get into the technicals here. Many different things are going on here, and this is one part of the chart. This is freestockcharts.com. So this will give you a different set of signals, stochastic signals, for example, than the other ones that I'll show you. So if you look at the daily on this, this is clear that we are not oversold yet. In order to be oversold, we need to be down here. A 600 plus point drop in the market. Yet when you quickly look at this chart, and I need a response from each one of you. When you quickly look at this chart, does it look like a complete breakdown, like the end of the complete trend change or whatever the case may be? I'm going to start off with 4 EMA trader. Your response, please.
No, doesn't.
Okay, that's a good quick response, and I like that. Keep it, just keep it to the point. Axida, and
No.
give me straight
Because
answer.
I think
I don't want any explanations, because the thing is, so you don't think that this looks like a really horrible chart yet. And don't give, and by the way, not to mention you, Axia, but anyone, don't give me answers to satisfy me. I don't need to know. I don't need to be satisfied with anything. I just need what you think. So good. So Axida, you I didn't want to cut you off. So you were saying what again?
no, I was going to say this is this price line. Is that what you're referring to, or did you want to?
Oh, I'm sorry. Thank you for correcting me on that. I need to have a picture of. Thanks, Axida. Thank you so much. So this, I'm going to take out all the drawings here, actually. No, I should leave the drawings here because they matter. These were all the previous things. So yeah, so this is the chart of good old the market, S&P 500. So answer to your question. So go ahead. So Axida,
The answer is still no. No.
Okay.
No.
All right, Marcos.
Sorry, what's your question again?
Okay, so my question is that when you look at this chart, this is a chart of the stock market going back to 2015, August 2015, okay? Roughly 1 year. When you look at this chart, does this look like, this is a chart of the stock market, the S&P 500, all right? So my question is, when you look at this particular chart, does it look like the whole market is about to completely crash?
No, I think because 34 and 50 are not trending down yet.
Okay, so your answer is no, we don't know yet. Okay, I appreciate that. Paris.
No, it doesn't look like, but it might be the beginning.
Exactly, that is the answer I was looking for. Okay, it might be the beginning, or it might be something, but we don't know that. So that's a good answer. That's an answer. That's good. That's a question. That answer that that's going through my head, because I don't know. That's what I was saying before. None of us know. It doesn't look like, but then at the same time, that candle, when you focus into it, is one ugly candle. That's $2.6 trillion. Whoop! 2.6 trillion. That basically evaporated in one single day. That's the reason there were 500% type of returns on the puts on the S&P 500. So the answer that Paris gave, a really intelligent answer, mind you, okay, is that it might be the beginning of something which pulls markets down quite a bit. So let's look to see what can happen. So given the fact that none of us have crystal balls, let's do some basic technical analysis on this and move. So let me take all the drawings out. And these are things that I've used in years before, and they tend to be great tools to figure out what might be going on. First thing you do when you get a big move on the market, like from the bottom to the top, or from the top, in this case, the bottom to the top, you put the Fibonacci retracement right over it. So the first thing we look at the Fibonacci's, and I've mentioned this before, is that generally speaking, when you get a monstrous move of the market from bottom to top, from 1800 to 2100, roughly 400 points. This is a 400-point move. It's big. 400 S&P point move, roughly 3,000 points on the Dow Jones. Okay, this is a 3,000 point move on the Dow Jones. 3,000 point on the D. I'm just going to put DJ as Dow Jones, and this is on the S&P. It's roughly 7 times, 7.5 times. You know, that's what the factor is, right? So a 3,000 point move on the Dow Jones. Most traders completely missed out on the whole frigging game, okay? Or they caught bits and pieces of it and that's it. Because they all kept on telling themselves, no, the market can't go higher. And now you get this big fat red candle, and they're the ones who missed out on all this tremendous rally are saying, oh, now we're going to make a lot of money because the market's going to crash down to 1,800 again. We don't know yet. I can make a strong justification from the bullish standpoint why that'll not happen right away. And I can make a very strong justification on the bearish camp why it can happen right away. So it all depends on somebody's perspective. But there are certain facts that we cannot ignore on the bearish side. This was a big, fat, one-day move, unprecedented. Unprecedented. Can so many smart people be so wrong? Yes, they can. And you just saw it. In my opinion, it had a lot to do, and this is something that maybe some people will talk about, but the reality of the story is this situation did not just happen because stocks decided they were all finished. It happened because the currency movements, the British pound, the English pound, the sterling, okay? I'm just going to put BP for British pound right now. Just collapsed. Biggest one-day drop in literally one of the biggest drops in its history. One day. So when the British pound does this, okay, what do you think, happens? There's a lot of hurt currency traders out there, hedge funds, institutional funds, macro funds, pension funds that just got, for at least for that day, got blown out of the water. There's a massive dislocation. A massive dislocation. And dislocations create right? Dislocations create massive sell-offs. Trying to draw the symbol for the pound. Actually, I almost forgot it for a minute. So that was one of the primary reasons for that. You had the British pound collapse, the dollar go higher, and that obviously caused massive dislocations that caused forced sell-offs in individual stocks. Like, honestly speaking, companies like Amazon, for example, they're multinational, of course, but bulk of the revenue is coming from the US. And more importantly, Amazon actually is the lowest cost seller of everything overseas. So they actually benefit during times of difficulty. Think about it. So why did the stock drop, whatever it dropped? What did it drop, like 20 points, 15, 16, 17 points? I can't remember. Because that's what happens. So the currency fluctuation was, the complete crash in the British pound was one of the primary reasons for the dislocation in the market. Not to mention the fact that when futures are down 104 points pre-market, you're going to see margins, you're going to see stops triggered. You're going to see all kinds of stuff. Even people who didn't want to sell had to sell. So that's what happened. So let's take a look to see what we can make out of this from a standpoint of numbers. So if we go strictly, let's stick to Fibonacci for a minute. Fibonacci retracements tell us that we kind of actually try to hold to 2060, if you remember, and I was guiding people through exactly what was going on. And that was a 78.6 Fibonacci level, failed that, and the 61.8 Fibonacci level comes into play around 2000. Around 2000. We closed the day at 2037.41, right at the 100-day moving average, which is still rising. Interesting, huh? The 200-day moving average comes into play at a critical number, which I've mentioned before, which is 2020. Got to just memorize these numbers. 2020, easy one to remember. 2020 vision. Markets crack 2020. There's going to be a flurry of selling, and there's a very good possibility that we test 1970 to 1980 real fast and create a very powerful tradable bottom. Another tradable bottom can be created at the 2020 level. So very simply, the 50-day moving average, I'm sorry, not 50-day, 50% Fibonacci level is at 1970. I believe the markets will get there. Does it get there on this round? I don't know yet. But I believe the market has to test the 1970 to 1970 level of the Fibonacci retracement sometime between now and August. How about that? Or maybe in September. Don't know yet. The sooner this happens, the better off it is for the longs to really buy some heavy duty ammo to buy the market. Period. Do the math. 20, let's say it's 2040, 2070. So you're looking at 70 S&P points between here, 63 S&P points actually between here. So 63 S&P points when we close that. Do the math. 63 times 7. And you'll see how accurate these things are. Another 63 S&P points, SPX points, drop to reach the promised land of 1970 on a hardcore retracement. Hardcore, that's a real reset. Is another 441 points on the Dow. Ladies and gentlemen, if we drop another 441 points on the Dow, roughly where do we reach? Somebody please give me the answer. It shouldn't take this long. I need an answer, please, that if we lose another 400 plus points on the Dow, where does the Dow roughly go to? The Dow Jones Industrial Average.
17,000?
Huh?
17,000?
Correct. Can I ask everyone else why it took so long for others to answer this simple question? I'm not going to go any further if I don't get a response. I'm being dead serious here. I'm trying to teach you guys. I'm not trying to coddle you. Marcus, why did it take you so long to answer a simple question? Like if we dropped another 400 points from here, where would the Dow Jones Industrial Average be?
I don't have the numbers on the top of my head, sorry.
Okay, that's a straightforward answer. Okay. So others probably didn't know exactly where the Dow closed. The Dow closed at 17,400. Now the reason I was saying that, I just want you to realize that markets are mathematical beings. They don't move randomly. 50%, and listen carefully because this is, I would say, 6th grade math going on here, okay? So 50% Fibonacci level brings us to 1970 on the S&P 500, which brings us to 17,000 Dow. I have said it before, I say it again. The Dow trades between a level of 17,000 and 18,000, 1,000 points. That is the large trading range on the Dow, and that is basically held for a long time. 1,000 points. Okay, on the Dow Jones Industrial Average. 18,000 and 17,000. Yeah, give or take maybe 16,900, whatever, but roughly 17,000. All right, so 1,000 points. So now, so what I'm doing is I'm walking you guys through the roadmap so you don't get freaked out like every time the market's down and you don't, oh my God, where is it going? So you can see, you have a roadmap in front of you. Doesn't mean that driving is going to be easy. Trading is like driving, right? Even though you know where the road is going to twist and turn, it's still hard to navigate those twists and turns. But the more you know how these numbers work, the better off you will be as a trader and as an investor. That's a guarantee. So the sooner we get to Dow 17,000, the better off we will be from a tactical bounce. But the markets never make it easy. The markets won't be like, okay, we'll take you to Dow 17,000 tomorrow. In that case, everybody would be short and the market would go the other way and kill them. It twists and turns and goes along the way. And those twists and turns, you can make money. Now, if you are convinced that the Dow is going to go to 17,000, you can take a one-way bet and just buy a bunch of S&P puts or Dow Jones. Even you can buy DJI puts, and turn off your computer and come back in a month and see where the market is. And you'll see the market's up to maybe 19,000 and you'll have a heart attack. So saying all that, when people say, oh yeah, I knew the market was going to do that. Well, great. I'll give you a lollipop. What does it matter? Because we have to make a living trading the markets. If you want to make a one-way swing bet, I can assure you, you will be down first, really big, before you even get there, if it gets there. I know, I have a strong feeling the Dow gets to 17,000. So if I know, then why don't I take all my money and just say, okay, I'm going to short the Dow all the way to 17,000, because it'll never make it easy. And that's what the tactical levels are all about. This is not, look, it's not happened yet. Can happen. Another fat candle immediately, another 700 point drop after a 600. I don't know why I keep on saying 700. But another 600 point drop after a 600 point drop is almost a zero probability. Market bounces a little bit, then collapses if it wants to get there. So let's go back to what we're talking about, which is levels. So levels of contact are the 200-day moving average, which is 2020, which is very close to where we are right now. 2020 is welcomed because that will give you an opportunity to really buy some strong stuff. Or if you're long, I'm long a few S&P calls, I'm long a few puts too going into Monday, the hedge. So I will take the profits if the market pulls back to 2020 and reposition those profits into my calls, which will be lower in price. Net, if it plays out the way I think it's going to play out, and it's done many times before, then it will be a big, big winning strategy. Take my profits off the puts as the market opens lower, let's say goes down to 2020. Take that and then buy average cost down on the calls. Average cost down on the calls at 2020 for that sizable bounce up to 2060, which I think the market can get to. 2050 to 2060 is my max target on the market right now for now. It can happen as early as tomorrow. It can happen as early as Tuesday, the reflex bounce. But it might not start at 2037 where we closed at. It might start at 2020. So the long positions will be down and you need to have some cash on the side to to, let's say you bought the options at 6, they will probably be down to 3. You will be adding at 3 and bringing your cost basis down to 4.5. Or if you buy more at 3, you can bring your cost basis down to 4. As the market reverses, you will hopefully sell them between 7 and 8, netting yourself 100% on your money. Now, if you think that, okay, and let's say you don't have any long positions right now over the weekend, in that case, if the market pulls back and these calls basically come down, you don't need to average cost because this is really starting a new position, win-win situation. So 2020 is key because the 200-day moving average also. But from a Fibonacci level, it's actually slightly below 2020. It is around 20. It's actually around 2000. That's a Fibonacci retracement of 61.8%. So this is a zone that the market can come down to. But there is strong support here. This is a daily chart that I'm showing you, a swing chart type of situation. Let's look to see on this particular chart what is going on a short-term basis. Let's switch this to a 1-hour chart. On a 1 hour, it is pretty likely that we get some type of reversal bounce. That's a 1-hour chart. We simply do this. We slip and slide. We are here right now, by the way. Futures are down 13.5. So we are actually technically down here already. As you know, a lot of the stuff happens after hours. The real crash in the market happened after hours. Think about it. So this is where we are right now as we speak with futures. This could be considered to be a tradable bottom. And that tradable bottom could net you some real decent money as the market climbs up to the previous low, which was around 2050. If you can get a sizable bounce from, let's say, 2025 or so to 2050, that's 25 S&P points. You don't need to catch all 25. Let's say you catch 15 of that. That's pretty nice. You don't need to do much. You sit back and you tell yourself you're a genius. But don't do anything stupid after that. Just sit back. This line also happens to be the same type of bounce that we saw back on May 18th. Do you see the pattern symmetry? It's pretty kind of clear when you look at it. This drop is obviously tremendous, but this could be a tactical bottom. It might slip and slide below that too. This is a 1-hour chart that we're looking at, ladies and gentlemen. Okay? There seems to be a sizable support at this level. Can everyone see that? So get ready for it, all right? Get ready for that. These type of markets are the most difficult markets that you can trade in. But if you can catch some good tactical trades intraday, take the money, sit back. All right? Don't try to overthink. Try to act. I'm telling you what the levels are, and after that you have to act. But they'll be fast. If you come in late, futures can, I mean, the S&Ps could be down 6 points from the time that I put my alert. So don't chase it. You have to look at your own chart and see where we are. If I put a tactical alert at 2025 and this one jumps up to 2040 within a matter of minutes, you have to think. Because at 2040, there'll be some sellers, probably pull back a little bit before it gets to 2055, which seems to be the natural magnet that the market wants to go to before it fails again, if it fails. So you can't come in at 2044 and then say, okay, and then within minutes, you're down 4 or 5 points. Depending on the size that you take, you're down, let's say, 20% on your money. You're like, oh my God, this is end. That's the point to average cost again, depending on where you see what the internals are doing. Right now, internals are in deep oversold. Now, deep oversold doesn't mean you're going to bounce right away. You can stay oversold, as you can see, for a bunch of days where you created this pattern of a dragon bullish, or inverted head and shoulder, head, left shoulder, right shoulder. On this one, we will have an initial V-shaped bounce, which will be sold. It could be a V-shaped bounce of only 50, 60, 70 points before the automatic selling comes in, then create a double bottom, and then make a move up to the 2055 level, if not higher. That's how tactical trading is done. You do not learn it in one day. You learn it in a couple of days, in a couple of weeks, by actually putting real money in the market. If you think you can tactically trade paper trades, you will never be a real trader because you don't have any emotions. Why do paper traders actually win a lot? Because there's no emotions involved. Because there's no money involved. Think about that for a minute. When money is involved, when the greenback is involved, when the US dollar is involved, that you're trading with US dollars, and that goes up or down, your emotions in your mind is at full alert. So shooting dummies in a field in decoys is not the same as being on a battlefield somewhere out there in Iraq, in Fallujah province, where some of the heaviest battles have happened, and the Marines did take over that town. That's the real deal. It's not the same as being in somewhere in the desert in Nevada simulating an Iraqi warfare. It's the same thing with trading. So even a few dollars will teach you more, which you will not learn in years if you keep on saying, oh, I'm just watching, I'm just paper trading, which some people do. Well, good luck to them. They'll never know the biggest component of trading, which is your mind, mental, emotional quotient, known as EQ, emotional quotient. You strengthen that one, you make bucks. You know how to handle losses. As a trader, if you don't know how to handle losses, you will never ever make it in this business. Am I clear? Am I clear?
Yes.
I'm telling you the biggest secret to this business. At the worst possible time, when they sucker punch you and these machines come in and sell against you and you know everything is looking right, and you put your head down there and say, shit. You put your head up again and say, shit, I'm just going to do it. That's it. You get that attitude, ladies and gentlemen, you will win this battle. This is a battle. This is not a joke. We don't get these type of percentages by just stepping into, excuse my French, shit all the time. I don't get lucky all the time. I work really hard to help all of you. And that's why we get these type of phenomenal returns. Even on bad days we do. And a lot of you miss it and keep on missing it and keep on missing it. So what do I have to say? I have to say that you need to get brain checked. Your emotional quotient probably is rated a 0. Your emotional quotient needs to be rated a 4 out of a 5, as in mental strength. Only then will you actually start to see the fruits of all this amazing work that's being delivered to you. What is a chart if you don't act on it? Remember that. Never forget that. That head goes down, and it's happened to me too, man. Okay? And you're like, ah, come on. And you put your head up and shit, that's it. That next frigging 3 trades I'm going to do, I'm going to make more money than what I lost in the last one. And all of a sudden you feel this energy in you that you never felt. That's the mark of a real trader. And even an investor, or anybody who's an entrepreneur, or anybody who is passionate about what they do. Let's move on. So that's a short-term level that we're looking at. Now, stows and all that stuff is, one second. This again, technicals, a warning, caution, good caution. Technicals will move really, really fast in type of markets we are going to encounter over the next week. Technicals will move really fast, so you have to watch them. Excuse me, you have to watch them very, very quickly, very, very quickly. And candles like this, there was a reversal candle at this level, they get snuffed out really fast. Now, the good thing that happened on Friday was we closed at the lows, because if you have a 7%, 6% drop in the market, okay, unprecedented, those are big, big drops, and you wipe out $2.5 trillion worth of actual value from global stock markets. You think the margin calls that are going to be coming, the margin clerks, especially on very large underwater positions, they'll wait around till Monday to sell? No, they'll dump it on Friday. Especially currency traders who got blown out of the water because the pound went berserk down. They had significant losses. The currency market is a multi-trillion-dollar market, right? So that's going to affect the stock markets too. So in a way, the last 15 minutes when the heavy selling came in after the candle reversal that I showed, in a way is kind of positive because they kept on dumping and dumping. We will, generally speaking, simply in looking back at past crashes, the best possible scenario that you can get is a powerful lower open, on Monday, a lower open, creating a real powerful reversal candle, okay, a reversal candle, which immediately gets sold a little bit, red candle here, okay, and then maybe does a double bottom type of thing, not at the same level, maybe a little bit higher, another reversal candle, sellers coming in here to sell a little bit, and then bang. But you need to see a lower open on Monday morning in order to do the flush, because people, they're not, like I said, the retail investor is not in the game, but they still own mutual funds. They read all over the weekend, oh my God, Brexit, Trexit, Frexit, whatever it is out there, Now Texas wants to, Texas always wanted to secede from the U.S. I think they should just give Texas back to Mexico, honestly speaking. They've always like, oh, we don't want to be part of the federal government. Well, good luck. I don't give a crap about the federal government, but seriously. So now they're talking about Texit. It's a joke, but still, Texas has a referendum. They want to secede from the federal, United States of America. You guys know about that, right? So if that picks up, great. So we'll have Texas, we'll have Alabama, we'll have whatever exit. America will no longer be the United States of America. Of course, that's not going to happen. But what I'm saying is that you need to do some sort of a quick fast within the first 2 hours. You need to see some sort of double bottom reversal in the markets. This is real deal. This is how it works. Okay. The first move down, if you have hedges, which I have a little bit, I'll be watching the tactical levels of what number, can I ask you, which I went explain, what is the number I'll be looking for, whether the market can hold there on the S&P. I talked about it extensively over the last
2020.
Thank you. Everyone clear on that?
Yeah.
That's it. It's not rocket science, okay? 2020. Now, does it mean it's going to just hit 2020 and start running? No, it can slip a little bit lower. We could test 2000, which would be nice. But 2020 is kind of the level that it needs to bounce over. 200-day moving average. So if it does that, then it might be like, S&P 2020, S&P even 2000. 2020 to 2000 is how many Dow points? Come on. I've gone through this a lot. Come on, guys.
140.
Roughly.
100, yeah.
140. Correct. 120, 140. You're right. Okay. So 140 Dow points. That's from 2020. So don't freak out. Individual stocks will really go woo, right? Now, if we are playing tactically, we have to be quick, because these type of movements will happen very fast, very rapid. I'm talking maybe 7 to 8 minutes sometimes. So the bigger the candle, as we are watching, the bigger the candle on the 5-minute charts and stuff, the better off it is. And if we quickly get into a tactical short like an S&P put, don't buy like 20 of them, because the market will kill you. It'll reverse so fast that buy a few, buy 1, 2, 3. You'll see it move fast. They'll double sometimes, many times. We know that, right? Buy small amounts. It's a win. So it'll be fast 2,000. At 2,000, there'll be big buyers who come in. Just pure stuff. 2020, there'll be buyers who come in. If there's a failure to hold above 2020, this drop will be very fast. Just letting you guys know that. All right? Now, below 2,000 is a real technical number. It's called 1980. Okay? And I'm not talking about Duran Duran and their hits in the 80s, okay? I'm talking 1980. So if we drop from, let's say, for example, it won't be a straight line drop. They'll try to fight 2,000. They try to bounce it off here. If there's a failure, 1980 becomes the real buy zone. Everyone clear on that?
Yeah.
Yes.
Yeah. So I don't know all that will happen right away, but could happen. Just letting you know, the probabilities are there for it to happen. Real panic sets in. Some other idiotic comment comes out of the UK. Out of England. By the way, the biggest Leave leader, Michael Farage, today backtracked on a lot of his comments. I don't want to get into right now. You can read all that stuff on there, you know. Whichever the case, there's a political vacuum out there because David Cameron is resigning, right? So when you have a political vacuum, markets hate it. So just letting you know, 2020, line in the sand. Slippage should be 2,000 in 20. These are 20-point increments. 1980, just got to buy. Now at 1980, whatever we buy, in my opinion, and let's say that holds around there. Of course, I'll be actively involved in letting people know, as I always am. You need to swing something. You cannot just buy and sell it in 5 minutes, even though it'll fluctuate. So you'll buy a little bit. You buy in scaling in, for example, like I say, scale in little at a time. Scale in little at a time. Don't go head on and looking for the perfect moment. There are no perfect bottoms. There are only perfect ranges of bottoms. Do you understand what I'm saying? So the perfect range of a bottom is basically 1980 to, and I'm talking about why we have to know these numbers, because all the stocks that we play, the big ones, the ones which really make the money, they all move within the S&P range. So 1980 to 2020 is considered to be a powerful buying range for the market. Get it? So this is your perfect moment. Once you get towards these levels, you basically want to swing for 24 to 48 hours. And that's where the biggest money is made. That's where the biggest money is made. If you're waiting around for the perfect 1980, it might not happen. Just want to be clear on that. So that's it. So that's on your short-term basis. That's the picture on the battlefront. On the daily, I mentioned to you, I've shown it to you already, and I'm going to move on to another chart. We are looking at this is where we are. So Fibonacci level I've explained to you is around the 1970, around the 1970 level, 50%. I don't think we get there right away, but who knows? Lines are still holding, surprisingly. 700, 600 point drop. I keep on saying 700. Maybe I'm looking forward to tomorrow because there's going to be a 100-point drop in the market right at the open. That's why I keep on saying 700. You know, it's funny. My lip just keeps on saying 700 points. We dropped 603. So bottom line is we had a very powerful reversal at this level. So that's the 20. This is more like 2025. So I'm going to be putting this up so you guys can all see it. Very simple. Lines are still going, believe it or not. The 50 and the 34-day moving average hasn't cracked yet. Another thing that's going on here is the standard deviation away from the 50 and the 34-day moving average. We have to take that into account. We were here. This is the big jump on Thursday, hitting exactly the levels that I talked about, which was around 2120. How far? Yeah, we got close to it. And the distance traveled between the 50 and the 34-day moving average standard deviation right now looks like it's a -5. The distance from here to here. Okay? Looks like it's a -5. I don't have the exact number in my head. That's a lot. But just look at it visually. You can see how far it has traveled from the 50 and 34 in a matter of 8 trading hours. So what happens when you move that fast from in either direction? What's the term?
Mean reversion.
That's right, sir. Mean reversion. So there is going to be mean reversion. Doesn't have to happen in 1 hour, but there will be mean reversion. Thank you, Marcus. Okay? And somebody says, no, it can't happen. Well, I'm like, come on. It's happened every single time. It's a technical move. Shorts will take some profits. I will take some profits on those few puts that I have. Because if the market crashes 300 points, I'm not going to take profits? Of course. So that's where the short covering comes in and the mean reversion start to take place. So on a mean reversion point, you can get up to these levels. Like I said, 2060, that's what I'm looking at. And if we do have a really powerful move and we revert completely back to the mean, which is the 50 and the 34-day moving average, then we are talking about some serious upswing. Then I'm going to do it in a straight line. They're going to zigzag it up, but then you can track the internals. Surprisingly, with the 600-point drop, we didn't see the internals completely crash and burn. That's good and bad. That means there's more downside to fall, or the market's strong enough to withstand that type of body blow, and the internals are still kind of sloping up. Does everyone see that? Real simple stuff. Does everyone see that? Right down here?
Yes.
Exactly. Let me make this thing bigger. All this I talk about is every single time the market crashes, I talk about the same things, and guess what? Every single time it does happen. What's difficult is, and I'm being honest, it's difficult for me too, is trying to basically play these swings within a reason, with having a very straight mind. The best way you can have a straight, calm mind is to have lesser money involved in the market during these times and take profits along the way, or hold it, knowing that if you do get hit on the other side in a big way, that you don't have that much money in there that's going to hurt you that badly. Am I clear on that? If you have small amounts, then you can actually be calm. If you can be calm, you have big, 5-figure type of amounts in an S&P option type of thing, because you got bullish on a big fat reversal candle. Guess what? You will be nervous. You'll sell early, or if it goes the other way, you'll panic and sell fast. You won't do that if you have half that size. It's behavioral game theory. Believe me when I tell you. However, at one point, if we do see any sustained reversal, you might want to stay swing and put a larger amount in there. Whichever the case, it's very interesting to see that with a thump like that, we didn't completely break down and come crashing down and get oversold. So the good thing is that didn't happen. So that shows a positive divergence because it's still sloping up. The bad thing is that means that it can do that, which means we are coming down to that 2,000 level on the S&P 500. Got it?
Yes.
There you go. So we have the Fibonacci's. We talked about the moving averages. Let's move on to the Thinkorswim chart, which is more dynamic. I was watching this earlier on. And by the way, I really thank all of you to participate in this thing, because I didn't want one person sitting there going, okay. It's good to have a great group of guys like you and girls, Exita's there. And it's encouraging. It's important to me because, after all, we're all in the same boat. And it's good to know that there are people out there like yourselves who are equally passionate in what we are trying to do here. So I thank you all. 1 second here. So let's look at this here. This is from a perspective of the Thinkorswim daily charts. So on a dynamic level, the dotted line is your 200-day moving average. We are basically exactly at that right now. Actually lower than that. We are 7 points lower than that. You can see that here. Let me make this bigger. Okay, ladies and gentlemen, let's hit the Thinkorswim, toss as we call it. So let me get that little highlighter. So here's your 200-day moving average here. That's roughly slightly higher than where we are right now. The 200-day moving average, I believe, right now is trading at 2016. I'm rounding off the decimals. And we are at 207 right now. Got it? So we are 9 points below the 200-day moving average. Quick look at the internals on the daily. We're getting there. We're getting there. We are on the one of the lines in the stochastics, you can start to see we're already there, as you see on the red line, which are serious buying opportunities. What we haven't yet confirmed is the secondary line joining us down here, because once it joins us down here, it's a kaboom moment. So maybe by the morning, futures are down 12 in the morning. If there's some panic selling on the first hour or so, I'll be watching this like a hawk. And if I see it anywhere close to 20, it is time to really add to longs. Is everyone clear on that?
Yes.
Every single time, my friend. I'm telling you right now. Look at that. This was the crash when we went to 1800. We're actually below that. Wow. See? The red line was at 16.3527. Look on the right-hand side. We are at 6.22 right now. You see that? Right there. Because of the pressure of the selling was fast and furious. Boom. Here was another great opportunity to buy the market. Back on the first week of May, we were down to where we are right now. Bottom line is, be a visual trader. If you start to see this green line staying up, that's a sign of strength. But if it comes down, that's a sign of real bargains shaping up in the market. Really simple as that. Another thing I want to show people, which I did notice today, we got a 600-point drop in the market. Why the heck? I can't answer this question. Can somebody tell me what I wanted to say? Why the heck the McClellan oscillator at minus 67 when it should be down to minus 200? You guys agree? Do you guys agree with what I'm saying? In other words, the McClellan oscillator, and again, look up the definition on Investopedia, but it's really a indicator of heavy-duty buying and selling pressure. Okay? So the oscillators, when we get real drops in the market, okay? Normally, like just the other day, when we said buy the market, because oscillator was at minus 176, I was talking about positive divergence going positive. That's exactly what we did, right? So with the thump in the market, why the heck didn't we get down to at least minus 100, if not minus 200? Personally, I would love to have seen it at minus 200. So the two explanations I can give to this. Number one, the panic selling did not come out of some large-scale funds. It was basically done on weak hands just getting out of the market. Okay, that's number one. And number two, that the so-called smart money, the invisible money, was buying, and that's why the selling pressure wasn't as bad. Did that make sense to you guys?
Yes, it does.
I mean, if anyone didn't understand that, I'll explain again, because we're trying to read the tea leaves here. So the McClellan oscillator, this is actually a positive divergence. The McClellan oscillator was only minus 67. Here the McClellan oscillator was almost minus 180. The S&P 500, I mean, in this case, the E-minis, follow me carefully. Look at this frigging volume. At the time, the McClellan oscillator went down to minus, what do you call it? Went to almost minus 200, and on this reversal time, minus 177, when we had that huge reversal candle that I showed and we acted on, we were at 2060. Everyone clear on that?
Yeah.
We are at 2022. At the close, we were at 2017. And the McClellan oscillator was higher. You get it? We had a lower price, a significantly lower price on the front side, but on the internals, it didn't match it. So that's known as a positive divergence. Does everyone understand that? In other words, the internal diverge positively versus the externals, which are the prices on the top. Everyone okay with that explanation?
Yes.
So you have to respect it.
Yes.
You have to respect it. I mean, every time I've seen something like that, markets have rallied on the short term. Every single time I've seen that. And this is valuable experience that's talking. But like I said, markets will slip and slide on the levels that we talked about. So let's look to see here on the front side what's going on. Futures right now are down 11.25. That's not normal. We had a volume spike. This is capitulation type of volume. It is capitulation volume of 4.15 million S&P contracts sold, net sold, right? Between the buying and the selling, that was the actual volume on the 24th of June, a historic day in the history of the financial markets. When you get to capitulative type of volume, it generally signifies a possible tradable bottom. Some of you already know that. So what I try to do is look to see when was the last time there was that kind of volume. So what do you guys see on the screen? Point me 3 times. When was the last time we got close to this type of volume? Look at the screen.
In August.
August of what? Oh, of course, you said August of last year, because we haven't gotten to August yet. My apologies. I'm being clueless as usual. You're right, sir. During the flash crash, right? So flash crash, we got 5 million changing hands. We actually got to the day before the flash crash where we had checked hands. So is it possible that we can get to 5 million on the sell side, on the selling side? Possible. Remember, this was the day, this was this candle. Then came the big ugly candle which reversed. That same day reversed. And then there was huge move. Markets went up like 400 points after that. Or more, 600 points actually, in 2 days, in 3 days. Huge money to be made. So point is, tomorrow might not be the bottom. Tuesday. Do you guys get it? Tuesday. Tuesday is also known as reversal day, right? Tuesday reversals, you guys heard of that? We've seen that happen many times, right? So,
Yes.
So if this is the capitulation volume, then it took another day for real capitulation volume to hit the market. So if that's the case, then we could get capitulation volume tomorrow. Get it? Reversal, whatever reversals tomorrow, we'll see. But Tuesday could be the point now. Now, in order for Tuesday to come, if you think you're going to buy the exact point, you're never going to catch it. So the best way to do it is to scale in slowly based on how cheap and how quickly it's getting to the levels that we discussed. Is that clear with everyone? This is pure trade strategy. That's the way I do it. Okay? So in the meantime, the last time we saw volume around 3.5 or close to 4 here was also in January, where we had that big powerful thump, and then we moved up fast. Then we created another double bottom, which had another capitulation volume. So if you notice what you're noticing here, and this was the last capitulation volume that we saw on the first week in June when we hit the lows. So capitulation volumes are good. It's pure flush. Have we completed the flush yet? I don't know. It's a good enough number for me to say we're almost there. So volume is important too, especially in the futures. Like I said, futures don't trade in dark pools, so you can always see them. Get it?
Yes.
Exactly. So looking at this chart here, is it starting to make some sense to me? And what is starting to make some sense is that we are at, again, at 61.8 fib. This nice little oval that I put out there is the point where things start to get really panicky. But you guys are not going to be panicked because you already know what these levels we can get to. People who tend to get very panicked, and traders too, as you can see all over stock twits and other forums, and even some people in our group who don't really, focus on what I'm talking about, but they'll be listening to this video cast for free tonight, is that we know that this zone can be engaged, correct? So we are prepared. We are prepared. We might have a red day on our P&Ls tomorrow, but I can assure you that little amount of sacrifice of dollar cost averaging down as these levels are hit will reap rewards in the next 24 to 48 hours going into Tuesday and Wednesday. Things can change. And I'll certainly alert people right away if I see a massive decline, which would bring us all the way down to, these levels. It can happen. But I'm saying, given the probabilities, like I say, a small amount of sacrifice, the pain of sacrifice is far less than the pain of regret, which unfortunately most traders do. They just live in a world of regret because they never did anything. So saying all that, this zone can be engaged. It's a very important one. People who just think or swim, put the Fibonacci retracements over it, draw a little oval, leave it like that. This is where the egg drops. Now, is it possible that the egg drops down here? Sure, because there was a point of confluence here of what we call a cluster right here. If you notice, see the cluster here before the market had this huge reverse, huge candle and then took off. Once you see a candle of this magnitude, I've talked about this before. Okay, once you see that like that, yeah, you got to get in the market. It doesn't matter, you know, this type of candle reversal is massive. This is this is a bullish engulfing because the size of the candle engulfs all the previous candles, right? The previous bearish candles. And you have to buy them, whether it's a stock, whether it's a market. So if somebody's waiting for this candle, that's a smart thing to do. They'll miss out on this big move. This is good for about 200% on your money, on the S&P calls and the RUT calls and stuff. But at least you know there is some certainty that if this candle holds, the market is basically ready to continue higher for at least the next couple of days. Plain and simple. Like from here, same thing. See? Reversal candle, but it's in red. Not confirmed. This next day confirmed it. And the market climbed higher for the next 3 days. People who bought around here made the most. People who bought around here did very well. Same thing here. Fat reversal candle. You can identify it. Go with it. So from here, we don't know if we're going to get one of those. But if I see one developing, I normally tend to be earlier, which causes me to basically slip and slide a little bit. But I dollar cost average in. And then bang. That's when you get those days of shooting fish in the barrel. But in order to do that, you have to keep your guts of steel. You have to you understand these levels that we're talking about. I know you guys do, so you don't panic. Remember, a Brexit only happens once, right? Yes? Exactly. So there's not a second Brexit there's not a second Brexit coming on Monday. There'll be fallout. There'll be after effects, aftershocks like an earthquake. But the bulk, the hardcore damage, in my opinion, for now, short term, is done. Just like anything else, the worst reaction is always at the moment of maximum event panic. Just like 9/11. Markets opened up a week later, dropped hard, and then turned around, started running, and didn't look back. I was there. I know it. So it's the same thing every time. 1987, same story. The crash of 87, where 23% of the market's value on October 19th was wiped out. Everyone thought we're finished. Markets came down for about a week, looked out, and you never saw the markets at that level again. Best buying opportunities ever. Is it the same this time? I have no frigging idea. I just think the contagion of Brexit can be contained. That's what I think. Because they kind of expected it, believe it or not, right? That this can happen. Okay, and big business, believe me, is not going to lie down and take it just because 58, 51%, or less than that actually, because 30% didn't even vote, decided that it's not a good idea to be part of the EU. Okay, so that's it. So this is what you have to watch. In the meantime, there are small candles developing here. These channels I have drawn. If we get back in this channel over 2022 E-minis on the futures, that's kind of good. Again, like Marcos correctly pointed out, you have a mean reversion play in picture, and all these are money in your pocket. You can trade small, but you will see the same percentage return as somebody who's playing big. I suggest stay on the small to moderate side, because big means you're going to be freaking out because the market will go against you, and all of a sudden you're down quite a few $1,000s in seconds, and that's not a good feeling. All right, so saying all that, I can't tell you what you need to do, but I can only show you what the roadmaps are. So that's it. Mean reversion is quite large, and I think we get we get to one of these levels here. We can get to, we are well past the Bollingers. That's another thing. These are the Bollinger Bands. I see it better on my other charts. These white lines. We overshot the Bollinger. That's another thing about technical analysis. Anytime you overshoot the Bollingers, you get out of the Bollinger Bands, you get in there. Overshooting the Bollingers means that you have a magnet that takes you back in there. So let's take a look at the Bollinger. Here on the 1 hour, we are still within the Bollingers. Here's your lower Bollinger Band. Here's your upper Bollinger Band. On the 4 hour chart, which I also look at, four hour is the closest thing to a daily. Nice to see a deep oversold territory. I always like that. Always like that. On the 4 hour too, I find it extremely funny that we are at minus 880 while we were at minus 344 when the S&P 500 was trading at 2060. Does everyone understand this positive divergence stuff going on?
Yes.
Look.
Yes.
Okay. Yet we went from here to here. So that is basically lower prices, higher on the internals, on the McClellan oscillator. Very interesting. Might be telling us something, but then we don't know till it actually happens. Oversold on the 4 hour, like that very much. Another thing that you might be seeing a pattern developing, don't know yet, but is a W pattern. Double bottom at around the 1999-2000 level. Remember, 1999 was where the market was down 400, 104 S&P, S&P futures were down 105 on Wednesday night. I'm sorry, Thursday night, okay? While we were doing a session, right, we were talking about it and it was falling. Little did we know that it was going to do that. So is it possible that we have a W-type double bottom formation with a max move of, in my opinion, like I said, of around 2060? Very, very, very possible. Okay? Very possible. Now, if this move can also happen overnight, then we're out of luck, ladies and gentlemen. In other words, it'll happen, overnight as the night progresses. And we can't do anything because we're not futures traders. Get it? This could already happen by the time we open. If this happens by the time we open, the internals are going to be overbought. Correct? Internals are going to be overbought. Does everyone understand what I'm talking about? This will basically go like this and get up here. And this will be up here, retesting the 50 and the 34-day moving average. Is that a time to buy or sell if you have any long positions overnight?
Sell.
Exactly. Sell. It works like 100% of the time. If you have any calls that you bought at the close or close to the bottom on Friday, you want to be a seller if you see futures up tomorrow morning, and especially if they're approaching the 2050, 2060 level. You take your profits and boom, you wait for the reset. Resets always happen. Sometimes faster, sometimes slower. Sometimes it takes a whole day for a 1 hour reset to happen. So what I'm getting at is traders get a lot of naive traders, ignorant traders who don't do these type of sessions or whatever, or listen to what they get all excited. Oh, it's a market, futures are up. Futures are up because those guys manipulated it up so they can smack you and take the profits and move. Remember those days last week? Every single day, futures were up till 10 a.m. and then bang, down all day. That's the turning point, around 10 a.m. But now we're so deep, so hard, we fell so hard, who knows? We might actually move up and, I mean, wouldn't that be crazy if this market did this pattern completion? I know I'd freak out. I'm like, what? It's very possible. I shouldn't say very possible. It is a possibility. Don't write it off. That the market moves from, of course, it's not going to happen in one day. but the market goes back and retests those highs of 2114, 2115 on the E-minis, which is around 2119, 2120 on the S&P 500, people will just freak out. They're like, what? In other words, it's not a fully broken market yet. That's the message. But damage has been done, obviously. We showed that. But short term, we're deep oversold. So that's the overall market analysis. It's very important that you monitor these levels because and of course, and I remind people to do that, but if you don't follow, if you don't have, quickly keep on looking at the minis during the day and you have active trading positions open, you might be, it could be very dangerous. Could be really dangerous. Okay. Another thing about thing. Now let me take a quick look at the Russell 2000s because those would be hard bounces too. Let's look at the daily chart. So on the daily chart, this happened. We had ridden it all the way, not from 936, but from about 1,000 or so, and it worked out fantastically well. Bits and pieces we traded. We had a nice consolidation channel. We had a nice consolidation channel, which broke out as oil kept on moving. And then that went up. It's a Russell 2000 is very, very symmetrical. This is the big downtrend line from the highs. Guess what we did on Friday? We came down and we closed above the downtrend line. However, right now we're retesting the downtrend line. Does everyone see that? Right here. See that red bar is the actual real-time bar right now. Got it? Let's look at the internals. Not fully oversold yet. But here is the other thing I don't get. One line, it's fast stochastics, the green line is still going higher. Like, what the hell's going on here? Do you guys see the kind of like the divergence going on? It's, I don't know. This has certainly come down fast. It got overbought. Now it's getting oversold. It has to get into this territory or at least hold this line, whatever the case may be. But we'll see. Oscillator, same story. Oscillator at 67 when at higher levels on the Russell 2000 when it was at 1150. Remember, we're at 1100 right now. At around 1150 when we had come down hard that day to 1135 and we had I told people to buy the calls. We were at minus 172. Yet, 35 points lower, we are positively diverging. Some interesting stuff going on the dailies on this stuff. Either the market is, I've already explained that. Same type of capitulation volume that we're seeing. In fact, the S&P capitulation volume was higher. So, we can slip and slide. A low end of the Russell 2000, these are great money makers too, if you play them right, is 1085, 1085, right here. Very strong support at trend 85. Not trend line, price line. I'm going to make it big and fat. There you go. Okay. Very powerful line here. So could be a drop of another 15 points, 14 points. Okay, to complete this pattern. And if it holds, it's going to move straight up to 1154. Russell 2000 moves in increments of 10 to 15 points when it's moving up or down. Don't take Friday into account because that was a black swan outlier event. But generally 10 to 15 points, you can do very well. The options are cheaper than the S&P 500. They tend to move faster. Am I clear on that? So if you're doing options on the Russell 2000, great way to play it. You could do cheaper versions of that through the IWM. So it's fine. So looking at this picture here is I'm going to start wrapping up now. So the same standard deviation is down here. In fact, this was quite a bit at 1080. Looks like we did hit 1080 on just like what do you call it? It's like a TV resolution. High definition TV, 1080. So 1080, strong support. We hit that. We bounced up hard, 40 points. Wow. On the E-mini, I mean on the Russell futures on Friday, and now we're at 1100. Is it possible we do another retest of 1080? I'd love that. But this, if this holds, we can still move up very quickly to 1125, if not 1139, just to check the underbelly, underside of the 34 and the 50-day moving average. So whichever way, there are opportunities here. All right, I'm going to have take 1 or 2 questions, and then I'm going to stretch my legs and call it a night. So questions, please. Anyone have questions? Marcos?
No.
None? Okay. Did most of the stuff we talked about, sir, make sense?
Yeah.
Good. Good. I know you're picking up on these things pretty fast. This is the oil chart. I just want to quickly look at it. I had drawn these channels a long time ago. Oil is on the lower end, testing the 50-day moving average right now. It can slip inside a little bit more. We have lower oil at maybe around 46 if possible. That's this magenta box. That's your thing. Darva's box. But so far it can also hold the 50 and make a move up towards the 34, which is around 48.70. So oil is, pretty okay. I think oil's going to be fine. Overall, the uptrend is still intact. That's what I'm trying to show you. Uptrend is broken on oil below 45. It's really as simple as that. So it doesn't matter what those, what the idiots on TV keep on talking about. If you look at the pure and simple charts that I've drawn on oil on the daily, you can clearly see that oil uptrend is still intact. Right there. Okay. And as long as it's trading above the 50 moving average, and I have to draw one more line, and that would be this. There. Below this, you can automatically see with your eyes that you're starting to make a trend change. If oil keeps on doing this, and let's say it doesn't do, and keeps on breaking below 45, that, my friend, is a breakdown. 200-day moving average on oil is 41. So if you're just looking at moving averages, then you would say, well, we can still go test 41. You're right. But from a trend perspective, a break below 45 changes the directional angles of an upwardly rising channel, period. The other thing we need to quickly look at is the Japanese yen, which is a fundamentally determining factor. The Japanese government has openly said they will intervene on the yen if it falls below 101. It hit 99 on Friday. Wow. That was overnight, by the way. Okay? That means with $1, you could only buy 98.99 yen. That means a very strong yen. With $1, we would like to buy 108 yen, and that's known as a carry trade. So at this point, we do have a hollow candle, but it looks like a reversal hammer, which means that it might point down. However, I am still seeing a positive divergence in play in the internals, which is very interesting. Lower prices, but look what the internals are. So there's a lot of positive divergences that I'm highlighting. Whether they play out or not, we'll see. But generally they do. It was deeply oversold at 0 almost on the stochastics when the Japanese yen was at around 107. Okay, that's 107 yen on the dollar. Weaker. Now it's at 101, and look where the internals are. Does everyone see this? So
Yes.
there is a positive slope to the basic stochastics internals, while there is a lower low at lower prices. Very interesting. Okay, any questions? What we would like to see in this, just so you know, if we see a reversal, we'd like to see it recapture above 102, 103. It would be absolutely lovely to see the yen at 106, which might be asking a little bit too much for tomorrow. But if we start to see a reversal of the yen higher, that means it's getting weaker versus the dollar. Remember, this is versus the dollar. So 106 yen versus $1 is hugely positive. So bottom line is we don't need the yen to break below 100, but that's an automatic trigger for the Japanese central bank, which has a lot of cash, to come in there and start buying the yen to make it stronger. In other words, this number has to go higher. Get it? So this is the point of maximum trigger for the Bank of Japan to intervene, interventions. So I think foreign exchange traders know that very well. But we would like to see it naturally climb higher like that, and you will automatically see the stock market dragged higher. So watch this once a bit too during the day, because this is your determining factor also on how the markets will hold up on Monday. Get it?
Yes.
Good. Read some of the articles and stuff that I'm putting across. The Spanish elections was actually a positive because that went to the Conservative Party again instead of the hardcore leftist party called the Podemos, which is like the Syriza party in Greece. Remember those guys, when they won the election, the market crashed. The hardcore leftists, they wanted to be completely like, anti-EU and stuff. Well, the Podemos party in Spain is the leftist party, liberal, hardcore liberals. They want nothing to do with the EU austerity programs and all that stuff. Rajoy, who is the Conservative Party prime minister right now, is still holding power with a slight majority. That's a good thing, because right now we don't need another Spexit, right? It's just add Ixit to everything. Spexit, Texasit, Texit, so that's it. So that's a slightly positive development. You will see a slew of very interesting political developments on the UK coming through over the next couple of days. Do not be surprised that if Parliament, the UK Parliament, decides to hold a hearing on almost right now 4 million signatures for a re-referendum on this Brexit vote. I highly doubt that goes through, but then at the same time, imagine if they had a poll and Brexit basically got defeated and Remain came in again. Holy cow. Then you'd know that we're just in an insane world. We are an insane world. So, but we've always been insane. It just comes out more now, thanks to Twitter. Just kidding. So bottom line is that stay calm, do tactical long-short trades. Hopefully our stock, Sarepta Therapeutics, gets bought out. Gets the FDA approval and jumps up $9. There are certain stocks I'm watching, like the BSPMs, which we trade very quickly. Feel free to play those. And I'll always be on the lookout for things that are not that are going against the grain. Do not be surprised by too much, because you already know what the levels we can be trading in. I'll be there first thing in the morning. Thank you for listening. Love to get some great referrals. And for all the new members, thank you for joining us. All right?
Thanks, Cliff.
Have a great evening. And this will be uploaded to the YouTube channel. Thanks for coming in. God bless you all.